Are you the hunter or the hunted? Stay tuned, traders. We're going to talk about that next. G'day traders, I'm Stacey Burke from Stacey Burke Trading. It's the beginning of the week. We had some huge moves last week. Pound crosses, gold. We went over price being in a box. We talked about the high and the low of the day. We've talked about the timings. We keep going over some of the basics over and over again because it's the same thing every single day. And today we're going to be talking about, are you the hunted or the hunter? And so it comes back to the primary premise, and that is, where is the money? Last week we went through the Goldman Sachs 10K filings about how much their average daily profit margins were, and it's very critical to understand this is a zero-sum game, and it's about somebody winning and somebody losing. And when somebody loses, the money goes from their bank account into the other bank account. And from the looks of Goldman Sachs, who is just one of the major players in the Forex market, if their average profits are 25 to 50 million on the bulk of their days, and over that on a smaller percentage of the days, and in excess of 100 million on some of the days, then you want to be focusing on what the smart money is doing. And we talk about the 12 candle window. We've gone over a lot of different scenarios, but the same situation happens every single day. They will create a high and a low. They will hit stops. They may hit stops from the previous session, from yesterday, from Friday, from Thursday, from the US high and the London low, whatever that may be. Off the bat, they will usually go and hit stops, maybe from traders who have taken a position into the close, and then they'll move to the other side. And often that high-low, initial high-low, even in the rollover, can give us some insight heading into the Asian 12 candle window, if indeed they're going to be continuing a breakout pullback situation, going through the previous day's high or low, or just hitting stops and expanding the range and creating a new high and low, usually within a 25 to 50 pip box, to then trap volume heading into the next session. So I always talk about the critical importance of timings, and there's two sides to that understanding. The first side is to understand when the market potentially is about to enter into a fast move. So I don't want to be sitting at the screen in a trade that goes 3-4 hours and only goes 25 pips. I want to position myself in the market as it's about to potentially move 25 to 50 pips in 4, 5, or 6 candles in a very direct one after another move. So, you know, I had a lot of questions on the weekend, and again, just to stop and say thank you. A lot of tremendous feedback. Again, a lot of traders, you know, start seeing and getting a lot of great results. A lot of new traders asking some simple questions, and again, just go to the Start Here playlist. And again, I try to review everything on every video. The most important thing to understand is that at the high and the low of the day, there's money, there's stop losses. And at certain timings, the 12 candle windows, that first hour will often be a stop hunt trap, taking traders into the extreme or hitting stops before reversing and either heading back to the other side, or in some cases we could have a breakout pullback and a continuation move. Now, every trader needs to do their own homework to understand when there's a peak formation potentially already in place, but we've narrowed it down to 12 candles, and I talk about the first and the last candle usually having significance because they will often indicate possibly a 1 hour pin bar, or that reversal on the 1 hour, and sometimes in the equities hour, the second or third candle, because they've already made the breakout. And we're going to talk about this today. We're going to review some of that on the charts, but it's understanding the timing cycle in that equities hour, what's happened or before that. If they haven't done anything, knowing that that equities hour then can become the stop hunt and trap itself. And if they've moved the market prior to the 12 candle window, knowing that you could potentially now be heading into a squeeze for a reversal in that third hour, plus or minus 15 candles, for an explosive big move back in the other direction. But these are all things that come from going back and working on studying the charts, the different behaviors, the low of the week, the high of the week. You know, I get a lot of questions that traders, you know, again, asking about trading outside of all those times. If it's working for you, I never suggest to stop anything that you're doing if it's working. These are the steps that I've put in place to, number one, help me identify the highest possibility setups, timings, and opportunities based on knowing that I can duplicate that day after day after day after day after day. I'm going to be doing the same thing next week, next month, 90 days, 120 days. But it's also designed to keep me out of the market so that when I get 50 pips, I don't go and give 25 back an hour later. Take my 50 pips and know that there's going to be another trade in the next session, maybe 25. I got 25 on gold this morning because I know that based on the numbers and depending on where I get in, often in Asia, that range may only be 25 to 50 pips from top to bottom. So there may be a 25 pip move that's fast. It may not go 50, but I'll get 25, take that, and I'm happy. And I'll go back this afternoon. I'm going to look at the London Open, and we'll be looking where the high and the low are, and then how that market behaves heading into that 12 candle window. They're going to do the same thing every single day. There's different variations of that. You know, I had somebody say on the weekend, summarize everything. There's a high and a low. Good luck with that. Well, I know a lot of traders have had some great luck with that, and there's, as I've mentioned, you can get 100 pips a day over various instruments, just understanding the significance of the high and the low. And then when it's not right, you don't trade because there's, in a majority of all the days, there's going to be at least one 50 pip move. And on some days, there's a couple of 100 pips. On Friday, there was easily a couple of 100 pips for traders who were on the ball from Asia to London to New York, trading 3 or 4 different pairs and targeting the highest probability setups. Now again, I'm happy to take my trade, lock in my pips and walk away. Friday night I didn't trade. I like to end the week on a positive, but that's just one of those things. The US session, sometimes it's late, I have other commitments. Every trader has to decide what their priorities are, but there's more than enough really great simple trades that happen 99% of the time on a daily basis. So keep it simple. Don't complicate things. 12 candle window, for all those people that keep asking me, the 12 candle window is specifically geared around the equity hour opening of the markets. So it's not the 12 candles before the market opens. It's not the 12 candles before the after market opens. It's 12 15-minute candles from 8 to 11 p.m., 2 to 5 a.m., and 8 to 11 a.m. New York Eastern Standard Time. Now, we've broken this down again. I mentioned I focus for primarily in that equities hour, but this first hour will often be the stop hunt and the trap all in one, to the high or to the low. Now in some cases, as we saw on Friday, we may have a low of the day already in place, but they may work down into that low without taking it out before engulfing it. So again, another question I got is I still don't understand where to get in. If we're at the low of the day, I'm looking for an engulfment and possibly a pin hammer together, or an engulfment depending on the timings of that first hour. I took a gold trade on the third candle because when it engulfed, that essentially, as the next candle was printing and breaking through the numbers, made that a 1 hour pin bar that was about to do a measured move through the peak formation that had formed heading into that 12 candle window. So again, if you're not sure what you're looking for, then you need to print off your charts and go back and study bar by bar, but understanding that timings are more important than you studying price, because timings are when the algorithms kick in, or when the big money comes in, or when they move the market, because they've just spent 5-6 hours trapping volume inside, And there's a reason why they're getting traders to go down chasing that fast move at the beginning of the market before locking it in and reversing it for the fast move back in the other direction. Now the British pound, as I mentioned, Trader Dave had an awesome trade on that. I know a few other people emailed me as well. That market came down in 3 lower levels from Thursday into 2 lower levels in Asia. They made lower highs, trapping volume, trapping blocks of volume as they went down into the close of the Asian session. And then they gave us the little 1 hour W into the London Open at the very last hour at the low of that 3 legs down for an engulfment at the London Open that exploded up for 50 pips in 4 or 5 bars straight up. But then the golden gift, they came back down to hit the stops over the next couple hours of traders that were long, and into the US session they went 1, 2, 3 to the high, took out the stops, inside bar, bear pin hammer for the move back down through the low of the day. So common sense, high of the day, low of the day, timings, round numbers. These trades will often be coming off of or pinning into round numbers, meaning where is your 50 pip box? So for traders or for people who keep asking where am I pulling these numbers out of my head, the numbers are on the chart. The numbers are on the chart. They're the price of the chart, double zeros and 50s. So the sweet spots indicator is down in the box below. It's an MT4 indicator. If you don't have MT4, I don't know, I just use MT4. So I know some other traders have sent me links for other platforms. If you ask inside the box, I'm sure somebody can share that with you. Understanding that the average range of stop hunt outside of the Asian range is 25 to 50 pips. So if they break out, now you wait. You wait until that market locks in a high or locks in a low by engulfing, moving sideways, and again usually at numbers for the reversal or the stop hunt back against the traders who are in profit, which again comes back to the simple concept. Okay, where's the money? So if you can look at a chart and say this is where I would have got in that last session for a long trade or a short trade, know where your stop is. This morning they went right back down in gold to hit the traders who were long into the close of the US session, straight down 25 pips, right off in that second hour, in that stop hunt hour, 717, 7 p.m., 1 a.m., 7 a.m. New York Eastern Standard Time. The hour before the 12 candle window can often be a stop hunt or an anchor point now for when the market opens. So they put a high in place, they put a low in place, they move the market in that first hour, and then they reverse back through the anchor point for the measured move. So average range 25 to 50 pips, stop hunt. Okay, the stops are going to get hit. If the stops don't get hit, nobody makes money. If the stops don't get hit and somebody loses, then nobody makes money. So forget all this stuff about fundamentals. If you're trading intraday, there's obviously macro cycles and everything else, but if you're the average retail trader and you're trading on a macro cycle, you're obviously trading on such a small lot size that whether it goes up 200 or 300 pips or down 200 or 300 pips is irrelevant. So I'm talking about traders who are positioning themselves in the market for a move of 25 to 50 pips with a tight stop, usually 1 ATR, 1 bar at the high or the low, shouldn't exceed 20 pips normally. If you get a bigger wick, 25, but again, when these markets are ready to take off, and if that's the right trade, it's not going to come back into your position. They've locked it in and they're going to move quickly, as we've seen, because if they move fast, that catches traders who are trapped up high or down low, and they can't get out of the trade without taking a loss or losing or averaging into a loser, blowing out their account, margining out their account. If they're selling down low at the low of the week on a Wednesday and they're going to lock it in and move it back to the high of the week, they could be margined out at 150 pip loss, especially if they've taken on too much risk for their account size. So engulfments and pin hammers. If you are not sure what a trade entry looks like, print off your charts, circle the highs and lows, look at what time they happened, and then be able to identify what that looks like so that when you're in live time, the number one thing I'm focused on is timings. Have they hit the stops? What time is it? Has there been an engulfment, a breakout, or is it a reversal trade? So keep it simple. It's all there on the chart, but only you can be able to process that in live time. If you're having trouble seeing that in live time, start thinking about the clock. Every 15 minutes, you're talking about 12 bars. 12 bars. 12 bars. You have to focus for 12 15-minute bars. So if you know what a perfect trade setup looks like, as each bar prints, if it doesn't look perfect, it's not a trade. If you miss a trade, if it takes off without you, and it's a big move, chances are they're setting it up for the next session for the reversal back through for a measured move, because they're making you chase the trade. Most of the good setups for that session will occur at the low or at the high once they've hit stops or locked it in. So if they've dragged a market down, as we saw in the pound on Friday, that was the stop hunt. That whole 3 levels of drop down heading into the London Open. They locked it in. They'd had 3 pushes down. They reversed the market, and it took off from there. So keep it simple, traders. If you're not sure, stop, watch, and learn. If you're not improving, stop, watch, and learn. Don't keep doing the same things trying to figure it out. Stop and relax. Focus on the timings. Ask yourself some simple questions. Where's the money? Have they hit the stops? Are we down low? Are we up high? If you don't know what it is and you can't tell, then don't worry about it, because maybe there isn't an ideal trade setup on that particular instrument.
Are you the hunter or the hunted? So we were talking earlier about the timings and just the repeating the same basics, sticking to the high and low of the day, timings, round numbers, engulfments, pin hammers. But the first hour often will be the stop hunter trap. Second hour, if we haven't seen that in the first hour, we'll complete that 1, 2, 3 to the high or to the low. That equities hour will often take traders, especially in the U.S. session, into the extreme for the reversal. But first things first, coming to the screen and just asking yourself, where is the money? Friday, we've gone through the charts, but Friday was an extended move down from the close of the Thursday session. We were at the low of through the low of Thursday, but the market came back into that first hour with a 1, 2, 3 before pulling back. So that gave us our temporary high of the day. And again, understanding they worked the low. Equities hour made another push down before in the third hour engulfing and giving us our micro W formation, and again understanding that there's money up top here. There's money above this Asian high. So they hit the stops, but we also now know there's traders who are long with a swing low off the bottom of the Asian range from that last move up. So just, common sense, we don't know what's going to happen, but the market goes into the high, into our Asian 12 candle window. We get a 1, 2, 3 engulfment of the middle structure. So this high bull is engulfed, and the market heads into the last candle of the first hour down into the London Open. So the market is in movement as it heads into the low of the day and the London Open down low. The market stop hunts back into the range before consolidating at the 50 pip box and giving us our bear pin hammer at the second candle of the third hour. So an example of the market selling off the high of the day, we have geometry at the top. Traders, if you missed this, had the opportunity. Now we have a big bull candle. And again, if you follow Al Brooks and understand the H1 scenario, they sell the high of the first bull candle in a down move. So we've already had our London Open. This is the stop hunt back into the trend on the last candle, getting traders to chase this move back up before consolidating, a little bear pin hammer, and dropping down through the low for a measured move. So each session, where's the high, where's the low? The stop hunt is back inside. So the first hour goes back inside. The first hour up top was at the high. They came inside. So just understanding that the stop hunt was back up inside of the trend, meaning now one push, first hour, equities takes us up in a 1, 2, 3. They engulf it, give us our middle structure, hit the high one more time, and then engulf the inside bar. There's our M pattern at the high of the U.S. session for a 50 pip plus move down. But today we're talking about, are you hunting or being hunted? And so when I come to the screen today, I look and I say, well, who's in profit? So this gentleman who's shorted the market on Friday night in the U.S. end of the U.S. session 12 candle window, who's short, he's up here somewhere. The market has gone up early, chasing that, potentially stopping out traders at break even before pulling back and engulfing, heading into the 12 candle window. But you'll also notice they broke above the first hour of trade. So often when this scenario happens and they've split the box, this area may hold as support now. They may have locked in a low from Friday, Monday. That bull gap on the open, they've pinned back through the low and hit the stops of Friday's low. Engulfing, pulling down, catching traders, shorting the market, possibly shorting down into this move that could explode. We have volume trapped down inside of this Asian range. So this may be a potential target, but if this breaks down and fails, we could see them roll over for a measured move. If this holds, we could see this market explode up and head back towards Friday's highs. Looking at gold, we talked about this on the weekend. Again, just the New York reversal, the explosion after 3 pushes down in the London session. But we head into today's session, and I talked about this morning. There was an opportunity for a nice trade down through the low, 25 pip stop pump, but then they've pulled back, gone 1, 2, 3 after the first hour down. They've pulled it back inside. Little bull candle and then a bull pin hammer that engulfs the low bear. The opening candle of the 12 candle window is a bull pin for the 25 pip stop hunt back up towards the first bar of the day before dropping down and getting traders, stop hunting traders who were in on the first bar bullpen or who are in potentially after the 3-bar reversal. So again, we have a similar situation where the market is now put in a high and a low of Asia. But we also ask ourselves, who's in the money from Friday? So we have the gentleman who shorted the lady who shorted the bullpen, bear pin hammer. And we have traders who are long off this morning's move from the stop hunt to the low of the day. So possibly stops down below the low of today. And also traders who are in profit from Friday's short trade up at the 19,100 level. That's a 100 pip box if they come above the 1900 level. And we have right now lower highs forming. We could get a similar situation to Friday where, as we saw in the pound, they made lower highs, trapping volume in the upper portion of that box before dropping down and then giving us a middle structure and a 1, 2, 3, a micro double bottom for the move back up. So on gold today, again, depending on how this first hour holds, they've possibly put a peak formation in already and gone into consolidation. We could see an explosive move back up above that 00 level, taking out the lower highs. But if this low of the Asian session fails, they could roll over off of 50 to retest that level down. So again, waiting for the market to show us their hand. They went 1, 2, 3 into the open for the stop hunt up into the first hour of the day. And again, they've come down and gotten traders who are long before pulling it back inside. So again, I emphasize the timings where once they give the high and the low, everything inside is now trapped. And we don't know if they're going to go hit the high first or hit the low first. They could hit the high, hit the low, and then go up. They could hit the low and hit the high and go up. But the timing window will give us an opportunity to either be positioned in at the beginning of the move, at the beginning of the session, or into the equities hour, or even into the third hour, but we'll have something off the low or off the high for a move in the other direction. So focus on who's in profit and how they open the session. Because if you're in prior to that, again, just as we saw, London gave a high and gave a low, they trap volume, they go back up to the high. Traders who are long possibly scalp something, and then bang, they come right back fast and hard. So you need to be working quickly either to break even or take money off the table. Every session they give a high, they give a low, and then they pull it back inside before they move and reveal what they're going to be doing. So keep it simple, traders. manage the downside, play defense, wait for them to show their hand, and then piggyback on the smart money. Have a great trading session, and may the markets go with you.
Hi traders, it's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.